Hello everyone, this is Terry with Futures.io, and as always, I'd like to thank you for joining us today. It's my pleasure to welcome back FuturesTrader71 from Convergent Trading for today's webinar, the CME Micro Indices and Important Lessons Learned. Throughout the webinar, if you have a question, please feel free to type them into the questions box, and I will do our best to answer them at the end of the event. This webinar will be recorded and posted on the Futures.io website within 24 to 48 hours. If you're watching this afterwards on YouTube, please do us a favor and give us a thumbs up if you enjoyed the webinar. And as always, please feel free to share, comment, and subscribe to our channel. It really helps us a lot. For trading news, events, and information, follow us on Facebook, YouTube, and Twitter using @FuturesIO. And now, without further delay, I'll hand it over to FT, and he will get the pop-up to share his screen again.
Good afternoon, everyone. Thanks for joining us here today. This is FuturesTrader71. My name is Morad Askar. Today is actually a follow-up on the webinar I did on April 25th, maybe, about a few days before the micro indices were released by the CME. I had worked with the CME for about, I don't know, maybe a year or something, I don't recall, before it was released. These are products that I've been pushing for since 2012. I want to remind everyone that derivatives trading is not suitable for all investors. Past performance is not necessarily indicative of future results. My opinions, the opinions shared during this session are my own. They don't reflect the opinions of FuturesTrader.io, Futures.io or anybody else. Here's what we're gonna look at today. I'm gonna run through a brief re-intro, so to speak, of the micro index futures. I'll run through a bunch of slides of what I brought up or talked about in April, just for those who are not familiar or haven't become familiar with the product. I highly recommend that if you're trading futures, this is the product to trade or to at least learn on. How have the micros performed so far? I'll show you some statistics. What lessons have we learned? Keeping costs down to trade live, ways that traders can take advantage of the contract. So I'm gonna kind of barrel through these slides and just go through the material. Please feel free to just pop your question into the chat box in front of you on the GoToWebinar panel, and Terry will hopefully get to it at some point, or he'll interrupt me if I need to repeat or explain something further. First, I want to start with a question. How many here have traded have traded the micros, micro ES, NQ, Russell, or the Dow? Have you all traded these products? Come on, you can participate, you can do this. And I was gonna ask, now type no if you have not. Type no if you have not traded these products. I'm very curious as to why not, but let's not turn this into an interactive discussion that could take hours. So it looks to me like about, I would say 60% ballparkish. I should have done a poll. About 60%ish have traded it. 40% have not, based on the answers here. So let's dive right in. What is the CME Micro E-minis? These are, generally derivatives are highly leveraged, and the mini indices are getting too big. The S&P is trading at 3,036 right now, times $50 per contract is a lot. It's over $150,000 notional value per contract. It's quite a bit. And so it has gotten to the point now where it's so highly leveraged, and with clearers and brokers offering $500 margins on these minis, I mean, the risk of ruin is so incredibly high, in my opinion. It's unfortunate that people can actually trade the minis for that little. Really, it's not wise. Current prices, many traders are using 366 to 1 leverage, 366 to 1 notional versus their account equity. This kind of leverage means the risk of ruin is extremely high. Traders blow out before they work out their edge. It takes time to work out your edge and your method, your control, all that stuff. It takes a long time, and most people lose too much in order to give themselves the time to do so. I saw this early on as I got involved with the public. I came online, I think in 2000 and something, 8 or something, and one of the biggest things I saw is that people, traders are struggling, generally struggle with their losses, and it's a lot of it has to do with fear, and the fear is exacerbated because there's so much leverage out there. So in 2012, I reached out to the CME and I asked for them to look into a micro product, which they didn't really do anything about for a while, and now that product was released May 6th. There are 4 new products: Micro ES, Micro NQ, Micro RTY, and Micro Dow. They are 1/10. They shouldn't say will be, because these are the same slides I was using for the presentation. Here's what they are. It's $5 per index point, or $1.25 for the Micro ES. MES is the symbol. The NASDAQ, it's $2 per point, or 50 cents per contract per tick. MNQ, or $5 per Russell point, or 50 cents per contract per tick. Symbol M2K, and then 50 cents per point, because it's a $5 mini, and 1/10 of that is 50 cents, and it's 50 cents per contract per tick. MYM is the symbol. They follow the same contract details as the existing E-minis. They're completely fungible within the exchange, so you can trade 10 minis versus 10 micros, and they basically, if you're long one, short one, they offset each other. Initial margin requirements for the ES minis is 69.30, for the micros 630, and the intraday margin is $100. NQ 8,360. Remember, my recommendation is to at least initially deposit a full margin per contract you want to trade. So if you want to trade 3 ES contracts, really you shouldn't be depositing less than about $20,000, ideally. Same with the micros, 630. Just deposit that much for trading the micros. My recommendation, and we shared a trading plan in the last webinar, we'll share it again through convergenttrading.com. We recommend 3 contracts so that we can control the risk, and I'll show you that in a minute. So anyway, you can look these things up, the minis versus the micro margins. Some of the key things I covered in April: key struggles for learning traders can be listed as undercapitalization, over leveraging, huge problem. Inability to get out of binary trading due to size of product. So you're trading a 1 lot, you're either in or out. There's no way to scale. There's no way to press a trade. There's no way to back off a trade. There's no way to take risk off and improve your average. Those are all problems. Traders can now enjoy low risk of ruin while they learn the crippling use of simulators beyond their intended purpose. This is one of the biggest issues here. Live trading is never like simulator trading. Now traders have a chance. So you can move out of a sim and into live trading at $1.25 a tick. There is still a risk of loss, of course, but at least now you're trading a live product. And with the way these things have launched and have come out and how they trade, there is a 1-tick spread through most of the sessions. So there isn't this elevated risk of huge slippage or a big spread or anything like that between the bid and the ask. So these have just been tremendous and I think revolutionary improvement to the futures industry, especially the indices. The ability to move into a higher time frame without worrying about high margin requirements imposed by the exchange. So swing traders have a much better chance of holding on to trades because they don't have to deposit so much or have so much on deposit with their broker, with their clearing firm. What was covered? Yeah, use the E-minis for historical probability. So this is what I would recommend. Keep using the E-minis, the ES, for your studies, for your charts, for everything else, and for order flow, but then execute on the micros. I'll show you here for a second how the order flow has looked. I mean, today has been a bit of a bizarre day, but this isn't a very good example, actually. Let's just back up a little bit, go into the prior session, a little bit better. So if you look at the liquidity here in the ES, it's pretty, you know, I have full depth, I have access to the full depth of the market, and you could see that, you know, you've got liquidity all the way up and down the ladder, you know, 30, 40 ticks up. Whereas if we look at the micros, there isn't very much shown here. It's just very clustered. Most of the size is within the first 4 ticks or so, and there's not much in terms of depth to go off of in terms of order flow and things like that. So use the minis, but trade the micros. Data for the micro minis is not likely to be reliable for some, but it's been actually pretty good, so I was wrong there. Position sizing, trade management to mitigate risk using micros. You know, I talked about how much capital is needed. If you're trading one lots, it's really difficult. The reason is the one lot limits your ability to actually work a trade. You know, if you're trading one lots, generally the account is not well funded, and binary trades require precision, which is extremely difficult in trading, especially in this day and age. With binary trades, you just have to be right or wrong, and you just take your trade, and that's it. But binary trades also provide no flexibility, no matter what product we trade. With 1/10 the size, we have the ability to trade more contracts. This is highly favorable, not because your broker makes more money, or the clearing firm or the exchange makes more money, but our concern is as perfect execution as possible, and having being able to play along with multiple contracts is really important. The minimum recommended size is 3 contracts in the micros, as discussed in April. And as I put into the trading plan, we would have the following bullets in our trading rifle: 3 bullets, 1 bullet that reduces risk. So this is our scale out bullet. We enter with 3, scale out, improve our average, give ourselves more room to hang on. 1 bullet that gets our short range target. So if we're trading an impulse pullback continuation pattern, what do you call it, an Elliott wave, wave 3, 4, 5, something like that, or ABC, we would have that short range target as the last high, the impulse high, and then anything above there is considered gravy. The last bullet captures the bigger move and gives us a strong R factor or profit factor, risk reward. Of course, there are multiple ways to initiate with more than 1 contract. When you have more than 1 contract, you can go all in, all out, all in, scale out, scale in, scale out, scale in, all out. And because psychology is such a huge factor, the preferred arrangement is all in, scale out. Just take your trade. And actually with the micros, I actually have kind of changed my mind a little bit on this. Scale in, scale out, as long as you're in control of your emotions and are aware of, as long as you're aware of your emotions, are in control of your actions. That's really how it should be stated. And you're not just averaging down and all of a sudden you've got 9 micros, 10 micros, 11 micros, 12 micros, because we're fading a trend down and we keep buying and buying and buying. Limit ourselves to 3 and just improve our entry in zones. The market moves and rotates in zones, not in specific perfect prices. So it's advisable with such a deleveraged product to take advantage of that potential. So an example of a scale-in: we're long 3 at 28.9150, a stop is at 28.8850, 3 points. We scale out at 28.94. Once we scale out at 28.94, the actual scratch point, for the two contracts remaining, because we took a profit on one, is 28.90 and a quarter. This is the point at which the trade is at break even, plus costs. And then once we scale out at 28.97, the remaining one contract now has a scratch point of 28.8350. See how that improved tremendously. We've pulled 8 points. We've moved our scratch point, or break-even point, to 28.8350, not stop, but the break-even point to 28.8350. The market comes back to our entry. We're long, it gets to 97, comes back to our entry. We scratch it, and then the trade is closed. We don't get as much out of that third contract as we would like to. We've averaged out on the trade, on this particular trade, we've averaged out 28.9550 from 28.9150. So we have about a, a quarter, 1 1/4 risk factor on this trade, but at least you had that opportunity to catch the move. I'm gonna skip this. I'm going to skip this and move on to this. This is really important. I provided a plan template, and that plan template's still at this URL. You are free to go grab it under convergenttrading.com/trading plan. Just request it, and it just outlines the pieces you need to have in place to have some sort of a trading plan. Trading without a plan is a great way to fail. We want to help you, of course. That's why I'm on here. So we will provide you with a boilerplate for the minimum elements that go into a plan. Go to this URL, again, convergenttrading.com/trading plan. So how have the micros done? So let me ask you guys, what do you think? So we know the S&P, let's just focus on one product, even though it's a complex of 4 products. The S&P trades somewhere around 1 million contracts a day, total, 1.4 million, something like that. Can you guys guess what percent of the ES is traded in the micros? Just give it a guess. What percent? So in other words, if you say 50%, then we're saying that the micros trade 500,000 while the S&P trades 1 million per day on average. 10, 20%, 19%, that's pretty accurate. 0.001, 35%, 10%, 20%, 4%, 30%. All right, let's look at the results. The red bars is the S&P E-mini volume per day since the micro was launched. Okay, since May 6th. You can see that on the left, May 6th. The blue is the MES, the micros. The yellow with the glare, the blinding glare, is actually the percent that the micros trade as a function of the ES. So on this peak right here, they're at 39%. 39%. This product reaches its 6-month anniversary or birthday next week, next Tuesday or something like that. And it's already trading somewhere around 30 to 40%. Okay, so these the bars are tied to the left scale, so that's the number of contracts. So you can see on May 7th, we traded a lot, over 2 million contracts in the ES, and you can see that in the minis, we did about 250,000. And then as during those times when we had a lot of volatility, the ES was at about 2.4, But now the micros are actually a lot higher. It's 700,000, 750,000 or so. And that's represented right here by 30%. The yellow line crosses the 30%. So those of you who guessed around 30%, that's where it is. This is tremendous. This is huge. This is a huge success for a newly launched product early on. It took forever for the E-minis to catch, to get traction when they were released in 1991 or whatever it was. I think it was 1989 or 1991. It took forever for them to get traction. And this product has really gotten as high as 40%, 45% on some days, pretty quickly, within 3 months. Pretty big win there for traders as well as the exchange. This really tells us something about what's going on. So let's take a look. Why is this? Oh, I see. Hang on one second. I apologize. Looks like I mistakenly hid these slides. Okay, so what lessons have we learned? We've learned that traders have needed this product very badly. This is why it's so successful. This is also why I started the conversation in 2012. That we also learned that armed with a plan and with a deleveraged product, traders will move from simulating to live trading a small product. How do I know this? Because I speak to traders every day through convergenttrading.com and so on. And a lot of traders have moved from simulating. Now, did this impact the ES volume? Did the ES volume drop while the micro volume rise? Evidence is it did not. It did not, but it's hard to measure that because of the amount of volatility we've experienced this year since basically April, May. We see a lot of volume coming up in the MES, but in the ES and the other indices, micro indices, we see volume just increasing and increasing and increasing, showing, proving to us that there's some pent up demand there. So we didn't take a hit in the ES. You can't argue, in my opinion, you can't argue that a whole bunch of volume went from the ES to the MES. A lot, there is that for sure, but I could make a better argument for the fact that there are traders who maybe were affected by the pattern day trader rule in equities, now have a small product to trade, or traders have come from a simulator environment and feel more comfortable shifting over to a live product with an acceptable risk. I mean, honestly, if you have $100 down day trading the micros, something's kind of off. Something's pretty much off. I mean, $100 in the micros per day is a pretty good daily loss limit, in my opinion, if you limit to 3 contracts. So that we also learned that the ability to trade a small product, but to trade multiple contracts has helped traders that I interact with execute better in their opinions and to stay calm. So we talk about this all the time, that the fact that there's a smaller product, there's less noise, anxiety, and fear. And so it kind of clears a path, stills the water, so to speak, for us to just execute more perfectly or execute better or execute with fewer mistakes. Remember, I've done many talks on Futures.io over the last, 12 years or something. And one of the things I keep hammering on again and again and again is the cost of errors in trading. Much of the people who struggle in trading, in my experience, are not tracking their errors properly. They're not journaling their errors, and so they keep coming back and making the same mistake again and again and again and again, and not focusing their attention on that mistake. Mistakes are things like FOMO trading, execution errors, fading our plan, micromanaging a trade. Those are all errors that are very common. Waiting too long, taking price risk for the benefit of more information, and so the trade now has much higher much higher stop loss point, and is no longer viable. So with that, we've learned that other micro products are needed, right? I'm sure you all agree with me that if we can get a micro crude, micro 10-year, micro bonds, micro gas, and natural gas, and so on, products with high volumes, if we can get those in a micro, I believe those will likely see the same amount of demand and success. I'd love to see micro crude, and so I've already had a couple meetings with those decision makers within the CME. The CME is about 2 blocks from my office here in Chicago, and I've really tried to impress upon them the need for a micro crude, because that is one of the top traded products by online traders. How to keep costs down to trade live. In my opinion, the true cost of trading is in the risk of loss. So there's a huge focus on, commissions. I'm going to beat up my broker on commissions. Fine. If you have high volume, then lower commissions make sense. The price that the cost of your built into your overall cost to the exchange is fixed for these products. The exchange is going to take its share of the cost, and so the only other place to kind of have a discussion is really how much commission is paid to your broker / clearer. If you're trading a lot of volume, then the commission and all that stuff can really have a big impact, but it's offset by the amount of volume that you trade. The more volume you trade, the more your costs per unit of trade goes down, and so there's room there for the broker to offer better rates. One thing I would say though is pay careful attention to the quality of your broker and the clearing firm that holds your funds. So the broker does not hold your funds in the futures industry. Only a clearing firm or an FCM, futures commission merchant, are the ones holding your account. So there's for those of you who are curious as to how to evaluate your broker or your clearing firm, I'm happy to do that. And then what we did is I set up a page on my website with the URL in front of you here, ft71.com/broker help case sensitive. I've set that up so that if you do want to consider how to reduce your costs, if you're having trouble with your broker or whatever, just let us know. There's a questionnaire in there. Just hit us up. I've actually sent that link across. Just let us know, and we'll be happy to do the best we can to help you out, right? I have many relationships, and I can put you at those places. I don't get paid for that, by the way. So in case anybody listening in is getting nervous that I'm making money on these commissions, as of this date, I don't make any money on helping you find a broker, and that's you can reach out and let us know. Ways to take advantage of the micro contracts. Create a sprint sample of at least 50 trades, walking your trade plan forward before going live. So before going live, take the time to have at least 50 trades on your sample set. We'll call it a sprint. Those people who are developers or in tech development will immediately know what a sprint is. But look to develop a sprint of 50 trades. And what we want to know is what kind of expectancy that sprint has. And then as soon as we have a positive expectancy, and you can determine how many ticks that is, you want to look at how many ticks per contract am I getting on an expectancy. That number becomes very important. and 50 is really the minimum sample. Then move to the micros with the aim of quickly proving or disproving your edge. So move into the micros, trade as small as you can, and the goal is to, as quickly as possible, prove or disprove your edge. You should expect to get half of your sim expectancy when you trade live. So if you had 3 ticks on sim per contract on average, then you should expect half of that when you go live, because your fills are not the same and your execution is not the same. There's a lot of noise that come in psychologically when we trade live. Also, on your sim results, you should be penalizing all of your resting orders should be penalized by a tick. So if you entered at market and then you exited with a limit order, then anticipate that you will not get that price. So your limit order to exit should be 1 tick away farther than the actual. So if my trading plan is, I'm going to get in, I'm looking for 12 ticks or 3 points on the S&P for a target, and I'm looking for 3 points on a stop on a 1-hour trade, you'll want to put your exit, because it's a limit order, you want to put it at 13 ticks. Leave your stop at 12 ticks because your stop is a market order. A simulator would execute it pretty much the same way, but you want to make sure it trades through 12 ticks and gets to 13 ticks in order to synthesize a live fill. That's going to be your sim expectancy, and then you want to take that live and test it on a micro. Okay, we didn't have that capability before, but now we do with this small product, even if it's a 1 lot. Go back to sim if you're not seeing reasonable results. Like your expectancy should be pretty close to what you expect it to be. Continue the cycle of getting quickly out of sim and into the micros until you're executing without thought. This is how we get to know our plan and execute as perfectly as possible. This is how we do it. You just go through these cycles. Just think of someone who is looking to compete in the Olympics in whatever. They're trying to do something in gymnastics, right? They're not gonna practice their whole routine. They're gonna practice that particular flip or a particular maneuver, and they're gonna just focus on that and then come back and critique that and come back and practice it and find out the weak spots, the errors, again and again and again and again. And then it gets to the point where it shifts from our left brain, which is our logical, serial, first in, first out type of brain, and it shifts into our right brain, which is like the quantum machine, where we don't think while we're executing, because we've practiced that motion so much that we, through these sprints and cycles, we've practiced this motion so much, we're no longer concerned about the outcome of any individual trade. And if you are no longer concerned about the outcome of any individual trade, but still have risk control under wraps, then you are just a long way. You've come a long way towards actually trading as a career professional trader. Okay, this is a big thing, and the only way to do that is to just cycle back, cycle back, cycle back. This is what we do in prop shops. Just cycle back, cycle, 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 execute, execute, execute. Okay. Once you can prove your edge per contract in the micros, it is time to increase size gradually in the micros with the aim of moving to the minis. In my opinion, we won't get rich trading the micros. Okay, we're not going to get rich trading the micros. A $5 contract isn't going to pay the bills. So it's intended to bring you to a point where you can move to minis, fund your account better, move into minis so that you can do this for a career. Okay, so that's what I have for you. If you have any questions whatsoever, you can always drop me a note at FuturesTrader71.com/contact. And as discussed earlier, I'm happy to help you with creating a brokerage solution which has not been launched just yet. It's going through a regulatory process. It's going through approval right now, and I'll be happy to hear what it is that you need help with, and I'll be happy to offer a solution when the time comes. You can do that at ft71.com/broker help, capital B, capital H. That's all I had for you for today. Let me know if you have questions. Terry?
Okay. All right, guys, if you have any questions, start typing them in, and I will ask them to FT.
I think there were some ones that came in earlier.
Yeah, I'm looking. What about price slippage on micros? How can we protect it from bigger slippage?
So let's look at the, unfortunately, well, we can look. So this is the micro book here. So let's go back to the active part of the session. Let's go back to say, this is all Chicago time, 1 hour behind New York and currently 5 hours behind London. So if you look at the COB, or actually I can bring up, this is the depth of market right here, and it's showing us the depth of market right on this edge. So let me get the pointer right here. And so what this order book is showing is exactly what's going on right here. Okay, hopefully everybody can follow that. So let's walk through that. We open and look at the depth. There's always a lot of size, 2 ticks up, 3 ticks up, 2 ticks down, 3 ticks down. So it forms this weird kind of hue colored area. The more volume there is, the deeper the color, the more the color goes into red on this product called CT Bookmap, right? You can find this product, ctbookmap.pro, and look at the book as we walk forward. So as I walk this forward, look at that book. Unless you're trading 30 lots, it doesn't really matter, in my opinion, in terms of slippage. But look at the bid offer. The bid is 2 lots at 33.25. Let's expand this a little bit. 2 lots at 33.25. The offer is 14 lots at 33.5. So it's a 1 tick spread. This is live data. Okay, it's a 1 tick spread throughout. You look at it. It's really tight. And so, you know, let's say you have a big account and you decide, let me see what it feels like to trade a 50 lot. You're essentially going to lift the first and the second price, and that should give you your fill. So slippage is not an issue for this product, in my opinion.
Okay. Do you have the percentages for the other contracts, the YM, NQ, Y2K?
I actually don't. I just did this little bit of homework. It's actually very easy to do. I threw it up. This is the same chart, but now it's in Excel. I just threw it up on a spreadsheet, equalized the dates, and I looked at, this is MES volume, this is ES volume, and I basically charted these. This column, and then I just simply divided the MES volume by the ES volume, and you can see there are days that are bright green on the scale here, where the volume in the MES is 720 versus 1.55 million. You can do this for NQ, M2K, MYM, and so on. You can do this very, very easily. You just export the volume, the volume part of the chart for the minis and the and the micros, and just plot them against each other, put them next to each other, make sure the dates are the same, and you would get that same information.
Okay. How do they synchronize the mini and the micro?
They have market makers that do basically a stat arb all day long. Generally, it's highly algorithmic. There's a big advantage to those who are making markets in this product if the products become disjointed by a lot, because then they can just put on a spread. It's not quite a risk-free spread, It's not a risk-free spread, but it's a close to it, because these products are both fungible on the exchange, and they can trade against these products. So right now there are machines out there, I'm sure, that are simply doing that all day long, making sure the prices stay pretty tight.
Okay. Oh, where did you go? Was the volume that you posted, was that based on the day session or the full session?
It's actually, you know what? Let me pull up the chart. 1 second. I believe I did it on the full session. Let me see. Yes, it's the full session.
Okay. How much of the MES volume is that arbitraging it into place?
It's hard for me to say. I would be lying to you if I said that I knew the answer to that. I have no idea, but I can't imagine that it's too much, because in general, it's you know, the participants in it are going to keep it in lockstep. You know, I don't know. If I had a gun to my head and I had to throw a number out, I'd say 10-15% of the daily volume maybe keeps it in line. A lot of times it doesn't trade. A lot of times it doesn't trade at all. It's just the bids and offers move with the product to keep them in lockstep, but there is no execution because nobody's actually crossed the market to execute or has gone to market to execute. So, you know, what you see in the order book versus what gets executed are two different worlds, really. I don't expect it to be very much, and over time, I expect it to continue to drop.
Okay. Wouldn't it be extremely difficult to transition from a 3-lot on the MES to the ES? Isn't it the same difficulty for professional traders to switch from ES to the big contract?
That's an excellent question. That is true. Here's the thing, and I'm basing this on my own experience and as well as the experience I've had with just seeing others develop and struggle and so on. It's not, you know, the bigger problem is not, hey, I'm going from 3 MES and now I'm having to trade, you know, 2 ES or 1 ES. The bigger problem is, hey man, I'm having these blowups. You know, this is the issue. The issue is in general, we're working on ourselves when we're learning more than we are working on the technical side, because the technical side is very finite in nature in terms of what you can do. You know, you may be trading whatever, a Renko chart against an RSI on a kind of mean reversion program, or you may be you may be trading a breakout system based on you know, Bollinger's extending and so on and so forth from one end to the other. That you can keep tweaking, and that's where people's attention goes to. But really, really, for those who've been around for a while and have struggled with learning to trade, it's a pretty tough nut to crack, although it's fairly simple. So the issue there is going to be how you're responding to taking the trade when it shows up, how you're doing your perfect execution, how you're playing along. It's not really, oh my God, I'm going from 3 MES and I'm moving to the ES. 3 MES is 30% of 1 ES. How could I move to 1 ES? The thing is, once you know, and you see this with prop traders all the time, once it clicks and you believe in and understand and know your trading plan and yourself, most of all, now I know this sounds very cliche, it doesn't really matter what you trade. So you can move to 2 ES with relatively good comfort. The only catch, in my opinion, is that you compensate for the margin requirement. You compensate for the leverage. So don't take your $2,000 MES account with 3 contracts, which is actually well funded, okay, for 3 contracts. That's about full margin. don't take that and go, okay, I've pushed this to look at me, I've had a 50% return, and it's at 3,000 contracts on 3 MES. So let me go trade 2 ES on the same, $3,000. Well, now you're taking a huge amount of, you're taking on a huge amount of leverage, and you have to be some pretty amazing person psychologically for that not to kick in. That a stop out now going to cost you $250, which is almost 10% of your account versus $25, which is 1% of your account. That's the problem. So it is a kind of a big step, but we want to make that step. You'll know when you'll make that step. This is why, in my experience, people who make the turn tend to make money very rapidly. If they do make money, it tends to turn up and take off quite rapidly. It's this new knowingness of oneself as a trader. So the move from a micro to a mini isn't a huge leap, of course, as long as you are well capitalized.
Okay. Do you believe that institutions are using the MES at all outside of the market makers doing the arbitrage?
I would think that they are. I mean, I don't know. I do have contact with some pretty big CTAs and so on. I think they are, because the micros offers a very, very fine refinement of their hedge. So if they have certain, before to hedge their option deltas, let's say, into a weekly expiration, they needed 304.72 contracts. Well, now they can put 304 on and put 7 MESs, right, to have this really a tighter hedge. So I think there is quite a bit of that volume is probably institutional in nature, especially around, this is why the chart kind of picks up around options expiration on a monthly basis. I believe it is being used for the purpose that the exchange has created it for, which is to fine tune the hedge for institutions as well.
Okay. Do you know anyone who has made the transition from the MES to the ES successfully yet?
I don't really know. What we do encourage at Convergent Trading is that is to share your, we share our struggles all the time. So we do these trade talks on Tuesdays, study halls on Thursday. We cover psychology. We have a psychology session. We have a group mentoring session once a month. So psychology once a month and group mentoring once a month. So you get to hear the struggles, right? And so we encourage people to share their successes, and we've heard some successes. We take the people's word for it, but we've heard some transitions from negative to flat or to positive or whatever. I don't know. I don't believe I've asked, and I don't know of someone who's moved from the MES to the ES and is continuing on the ES successfully after trading the MES. I can't answer that question.
Okay. What are the fees for your services?
The only service I offer now is Convergent, which is a virtual online prop environment, and we're still at beta pricing at $69 a month. But I'm not here to pitch or sell you that. It's intended to be an area, a place where you can find an accountability partner and kind of look at what other people are doing and grow. But honestly, I don't come on to Futures.io to peddle something. But if you're interested, you can look at it. I don't offer a brokerage solution currently, but I will in the near future.
All right, I want to make this the last question. What would be a safe number of contracts to trade the MES or MNQ if one had a $30,000 account?
Okay, so for 30,000, you can essentially say you can essentially trade 4 contracts and be well within the full margin requirement of the exchange. But that 4th contract, if you have a negative expectancy, is simply increasing the amount of loss you're taking. So even if you're funded with 30,000, I'm sorry, 30,000 is a lot more than that. What is that? It's 40 contracts on the micros. With 30,000, I would say, if you don't have a positive expectancy, there is no sense. There is absolutely no sense of trading more than 3 contracts at a time and giving yourself, or more, or 2. I don't know. Just don't trade 1, in my opinion. If you can work on a sprint and with the smallest amount possible to prove your edge, that's what you're after. I don't care if you have $1 million account, because we're not looking at a return as a percentage of equity on deposit. We're not interested in that. We're interested in just straight up expectancy, because the goal with expectancy is if it's positive, then we want to push that expectancy by increasing size and getting more out of the trade, adding more risk, but also getting more out of the trade. And we want to keep pushing that size. That's what we do in prop. When someone makes the turn, you don't say, hey, move your time horizon bigger, go swing, or go, extend your targets, go shoot for the fences. We don't do that. What we do is we say, when can you trade? Or you're trading 2, when can you trade 3? How soon can we get you to 4? How soon can we get you to 5? What do you need to trade 6? Are you stable at 6? Let's go to 7. And we want to find that kind of point of breakage. And we want to push a trader to trade as much size as possible while exploiting that edge. That's how you make real money. And then if the system is not in favor with the current market regime or whatever, then we go from 7 to 6 to 5 to 4 to 3 to 2 and stay there until expectancy picks back up. And we go 2, 3, 4, 5. So if you have more than the initial margin requirement, trade as little as possible, leave the rest of the money there. Don't trade it, and don't swing for the fences. Don't decide that, oh my God, I'm trading so poorly and I've lost $3,000 trading micros, so I'm gonna just trade 10 lots. That makes no sense. Sure, go ahead and donate your money to other people who are trading better than you, but why would you want to do that? So minimize the amount of exposure that you have. I mean, a broker will tell you that, yeah, trade more. Here's more leverage. Here's a smaller margin requirement. Trade, click, 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 because that's how a broker makes money. But really, the goal is to have a longer term existence. I'm better off, even if I were your broker, I'm better off with you trading less for a longer period of time and stably increasing your skill set, and then hopefully your P&L follows. So with 30K on the MES MNQ, it's the same thing. How many contracts do you have to have as a minimum? Trade that minimum until you prove that you actually have a positive expectancy. That's where I would go.
Okay. Thank you for the information, for the webinar, and for spending some time this evening, FT.
Absolutely. It's been a pleasure. Again, if you need to reach out, ft71.com, broker help, or FuturesTrader71.com, contact. If I can help you in some way, then I will. If not, I'll point you in the right direction. Good luck, everybody. Thanks, Terry, for hosting me, and wish you the best of luck. Take care.